Good evening. Thank you so much for taking the time to join us this evening to learn more about debt management. This is the kickoff start of our third series, actually, or fourth series. I really can't keep count right now. But today we're actually starting off our new series about debt management. So thank you so much for joining us, and let's start. So as normal, I will be turning off my camera so that we can focus on the slides and the presentation I have prepared while I teach. And then, of course, at the end of the session, we'll be able to take up any questions. Here we go. Okay. Just to kick us off, right? Debt Management 101. All right. So, what is debt? So, ideally, debt refers to an obligation, of course, that one party owes to another. So, if I borrow money from someone and that person agrees to actually lend me the money, then, of course, then I am now in debt in terms of having to pay that particular individual back the amount of money that I have borrowed. All right. So this could, of course, be goods and services, but ideally, we're going to be focusing more on the transactional side, which then speaks, of course, to the money aspect of the debt, right, and borrowing money. Okay. So as we kick off, right, what is debt? Here we go. Debt refers to an obligation that one party owes to another, typically involves, of course, goods or services or borrowing money. So if I borrow money from person A, that person is going to be the lender, I would be the borrower. I know sometimes people get confused when it comes to those terms around who's the lender, who's the borrower. So ideally, the person who's going to be borrowing money is the person who's going to be the borrower, and the lender is the individual who actually owns the money and lending out the money to the particular person who is currently borrowing the money. All right. So another thing that I wanted us to actually start off with when it comes to debt is to just go back to the basics, understanding the difference between secured and unsecured debt, because there are two types of debt that we, of course, normally utilize, secured and unsecured. And basically, unsecured debt, as you'd hear the term unsecured, it just merely means that the amount of money that you're going to be borrowing, there is no security that you've put to try and secure this particular debt. For example, so if person A has borrowed me money and I don't pay the money back, then it means person A does not have any recourse in terms of trying to get the money back from me, because they have nothing in terms of collateral to try and ensure that they've backed up this loan, to ensure that Nonjabulo pays me back. I'm going to take her cell phone, for example. So there's no form of collateral that they've taken for this particular loan that they've given me. And that is why it's called unsecured debt, because it is a bit risky. And as a result, this is why even when you go to the banks, when you get unsecured lending, the lending options for unsecured products are very high when it comes to the interest rates, right? And then let us look at the other type of lending, which is the secured debt. And of course, if there's unsecured debt, of course, there should be secured debt. And secured debt just merely refers to debt that has been backed up by collateral or some form of an asset. So sometimes people would cede their securities in terms of bonds, or if they've got maybe a policy that they're going to cede to the bank to try and secure that particular debt, or they're going to be purchasing a particular asset, right? That now speaks to that particular lending. And of course, we're going to just delve a bit deeper when we go through the different types of these types of lending, right? But merely secured lending, it just means that there's some form of security that the person who has lent you the money has some form of security that and recourse in a situation where you don't pay them back, then they know that they can be able to seize that particular asset or finances of sort. Then they can be able to actually try and utilize that asset to recoup the money that they've borrowed you. So merely saying that if person A has borrowed me money, they borrow me 5,000 Rand and they say, Nonjabulo, as collateral, please give me your cell phone and I'm going to keep your cell phone until you pay me back. So if I don't pay person A back, then person A can be able to actually sell the cell phone so that they can be able to get their funds, recoup the funds that they've borrowed me. So basically, that is the benefit, of course, of secured debt, because there is always a way for you to be able to try and recoup the funds that you've borrowed to the particular individual. All right. Now, if we're looking at the types of unsecured debt, right? Firstly, the personal loan. This is probably a favorite. A lot of people possibly have personal loans, all right? And if we look at the different personal loans that they have, I mean, normally a personal loan would start up from 5,000 Rand and above, right? If I'm not mistaken, they go up to 250,000 Rand per the NCA, which is the National Credit Act, right? I'm not sure if they've changed it any time, but currently, if I'm not mistaken, it still goes up to 250,000 Rand. So that means you can get a personal loan up to 250,000 Rand. Okay, then of course, another one is a student loan. Student loan is another example. There's no form of security, right? You can't, the institution can't come back and say, hey, we're going to hold your university degree as collateral until you pay us back. Well, unfortunately, they're not going to be able to do that. So yes, it falls under unsecured debt because the banks and all the other financial institutions that actually offer student loans have to then find other means and ways to actually recoup the funds from the individuals that they've borrowed the money if those individuals happen to not pay the money back, right? And then, of course, microloans. Microloans are normally, a lot of people actually opt to take microloans. I know that some financial institutions actually also offer microloans just by you visiting an ATM and just putting in your bank card. Then you are offered a microloan of, I think, up to 5,000 Rand or less, just via the ATM. If you click yes, you can go through the quick, easy steps, and then you can have the funds credited in your bank account without actually visiting a branch. The only disadvantage with these little microloans that banks offer is that they don't actually spread out the payment plan in terms of you having to pay back the funds. So normally, sometimes they'll just take the funds. They will take the funds maybe in the next 3 months. It's normally a very short loan when it comes to a micro loan. It's like nothing more than a year. And that's why it constitutes to actually fall part of the term or definition of being a micro loan, right? So those are very popular, amongst people where they think that, okay, if you don't have an emergency fund and you need funds quickly to do whatever that requires, maybe you've got a plumbing issue, you need to buy a new tire, anything that falls in the category of an emergency that people that have not catered for with utilizing the emergency fund option and saving towards an emergency fund to cater for those emergencies. A lot of people then tend to go and actually borrow and get microloans taken out for less than 5,000 Rand, right? And unfortunately, just like unsecured debt, as I mentioned, the interest rates are quite high. So you do actually end up paying quite a hefty fine just for borrowing that amount of money. And unfortunately, these are kind of situations that people can avoid just by trying to actually budget better and identifying how much money they can afford to save in order for them to save towards a emergency fund, which we've done in our previous classes. And if you've missed it, please go to our YouTube channel and catch up on the savings lessons, right? And then, of course, another favorite that people like is the credit card. Ideally, the credit card is something of revolving credit, right? Similar to revolving loans. You pay the money back, but the money is still available for you to use. And that ideally would be the difference between a personal loan and a credit card. So credit card and revolving loans work hand in hand, because the minute you pay back the amount of money, the funds are still available for you to then utilize again. That's why it's like revolving credit. So a credit card and revolving loans, I would both couple those two under revolving credit, because they are always available for you to utilize once you've paid it back. Okay. The similar with an overdraft. An overdraft works the very same way. You get funds as an overdraft, and the minute you pay it back, you're able to actually utilize that overdraft facility until you go to the bank and say, hey, cancel this, or I want to pay it off, and please cancel the product after I've paid it off. So credit card, revolving loans, and overdrafts all work hand in hand, because it's revolving credit. It then allows you to be able to pay it back and then have those funds available for you to utilize, which are an amazing product. But unfortunately, because people utilize them for the wrong purposes and the wrong manner, then what tends to happen is that people then find themselves in situations where they've got numerous credit cards. Credit card is something great to have if you know that you happen to maybe travel a lot and you'd want to utilize a credit card facility when you travel, of course. And then if you want to keep it as something of an emergency, instead of, if you don't have the finances to save towards an emergency fund, getting a credit card of maybe 3,000 rand or so, normally people would normally utilize it for that manner. But what I've tended to realize with a lot of customers and clients that I've engaged with is that, unfortunately, because the lack of discipline is what we fail to have as people, and that is why we find ourselves in situations where people have credit cards that are owing over 50,000 rand, 100,000 rand, and that's already the wrong utilization for that particular product. You're not meant to be having a credit card that is owing so much money, because you are basically not utilizing the product in the right way it was meant to be used. Like I mentioned, that it's a revolving credit, just like a revolving loan and overdraft. So every time you pay that money back, it's available for you to use it again. Remember, if I have a credit card of 5,000 rand, for argument's sake, right, and I pay it off, okay, that 5,000 rand is still available for me to utilize again. Okay. And if I don't use it, I don't pay any interest, because what am I paying interest for? I'm not owing the banks anything. The only thing I would be paying would be the service fee, right? And if I've taken some form of insurance in terms of credit protection, that would be the only things that I'm paying for. So what normally then happens is that people would take these credit cards and take 20 or 1,000 rands or 30 or 40,000 rands on a credit card, and they are no longer utilizing it as a revolving credit, but now are kind of substituting the credit card as a personal loan. Whereas a personal loan, the purpose of a personal loan is for you to be able to borrow money for that particular purpose, pay that debt off, and then it cancels. However, now what happens is that people then substitute a credit card, right? A personal loan with a credit card, and then they start utilizing the credit card as a personal loan, having 30,000 rand on a credit card, right? Which then means the person is not able to pay it back off, and it no longer works as a revolving credit. And unfortunately, the interest rates, right, are quite high in unsecured debt. So can you imagine now, in a situation you're owing 50,000 rand, and unfortunately, people then take comfort with the fact that I can pay this credit card off, with 2,000 rand, 1,000 rand, or 500 rand, depending how much I can afford. And I've had an engagement with a client that has had a credit card for 20 years. And I did the calculation for her, and I was like, do you realize that if you had bought a two-bedroom flat at that point in time, you would have paid this two-bedroom flat off with the same amount of money that you've been paying towards this credit card? So it's important to understand that these different products, they are available for different reasons, right? So if you're getting married, or you want to pay a particular debt, you want to get maybe a deposit for a house, a deposit for a vehicle, personal loan is the way to go. because you are getting that particular debt for that particular reason, right? And then you paid off a little bit of a time, right? Unlike credit cards are more revolving. So, like example, like I gave you an example that if you want to have a credit card for an emergency, you want to keep maybe 5,000 Rand credit card, you keep it in a safe place. I normally advise that rather not have it in your wallet, because if you have it in your wallet, you know the money's there, chances of you actually utilizing it are very high. Versus some, I've seen very interesting tricks that people have been using where they've put the credit card in a glass of water and then put it in the freezer so that they avoid utilizing it because it's frozen, right? So those are other smart ways to actually put the credit card away so that you don't use it. Because what tends to happen is that people then start using it for purposes that it's not meant to be used, right? So revolving credit is normally just there for you to be able to utilize it continuously, right? This month I needed the money, next month I don't. So it's there for those emergencies if your emergency fund that you've saved up does not actually cater for the full or pay for the full emergency, right? So just understanding the differences is quite important, especially if you're thinking about getting some form of debt, having a discussion with the consultants or so, just to get them to explain to you the different types of debt so that you can make sure that you select the right product for the right reasons when you need the funds, right? Okay, so the next one that we're going to look at, of course, is the secured debt. And as I mentioned, secured debt means there's some form of asset that has been secured in terms of collateral. If you don't pay, there's something I can utilize to be able to recoup the funds, right? So home loans are always a popular one, a vehicle finance, building loans, and secured lending, right? Secured loans. So let's start with building loans. I know that a lot of people are familiar with a home loan and a vehicle loan, right? But a building loan, normally what happens is that if I want to build a house, right, I wouldn't go to a bank to get a home loan because I don't have the home there. So a home loan is normally utilized for complete structures, and a building loan is utilized for a structure that you're still in the process of building. So you've got the foundation, and that's very important. Normally, banks would want you to have a foundation firstly, right? Or at least 20 or 30% foundation done in order for you to qualify to apply for or qualify to be considered for a building loan, right? So you can't buy a piece of land and say, I'm going to get a building loan to build a house on this land. You would have to build the foundation first before you consider going to a bank to actually get funds to build that particular structure you want to construct. All right. And then a secured loan, like I mentioned, that you would have to put some form of collateral, right, in terms of that particular loan. So let's say I take a personal loan and it's quite a large sum, for example, that 250,000 Rand max. And so the bank says, no, Njobolo, we're not comfortable borrowing you this amount of money. So what can you give us as some form of security, right? Then it means that I would now look at the assets that I have for the bank to then determine what kind of security they can be able to take for this particular loan. So I would either have to give them a policy, any of the assets I may own, or I would have to actually see to maybe my business to say, okay, can we consider taking my business in terms of do evaluation of the worth of my business for you to see if you can utilize that as collateral or so. So this secured lending is a bit less riskier for the banks, right? Because there's always something that the bank can utilize to be able to sell off so that they can be able to recoup the funds. Hence why interest rates, yes, they are also high, but not in comparison to unsecured lending, because the risk is actually less because there's some form of security that is tied to this particular lending product. So just to illustrate this a bit further, I want us to look at an example. Yes, of course, we need to have an example just to ensure that the understanding of these products is well vested, right? So let's look at Tando here. She is a nurse at a private hospital. Oh, nice for you, Tando. And she earns 23,000 Rand a month. She then needs a 50,000 Rand loan to pay for her daughter's university registration fees. So Tando has a few lending products and she's not sure which product she should apply for. Interesting, Tando. So let us look at Tando's budget. Here is an illustration of Tando's budget. The income she earns, of course, we've got it on top and it's normal as 23,000 Rand. And then the expenses are then listed below. So she's got her rent, she's got a vehicle finance, she's got insurances. I presume that her insurances encompass the vehicle insurance and all her other policies in terms of life insurance, funeral cover, and so forth. And then, of course, she's got groceries, she pays electricity, then she's got monthly school fees, she's got a personal loan, she's got a credit card, she's got a clothing account. So her surplus is about 1,400 Rand, right? So 50,000 Rand is quite a large sum that she'd want to pay off in terms of getting a loan. So ideally, just by looking at her bank, at her budget, I can actually say that, in terms of affordability for her to get an additional loan or an increase on the current loan, chances are not so much because her surplus is only 1,400 Rand, right? So what I then would advise in these kind of situations that people normally don't consider the options that they have, especially when they want to take out credit. That is why I say it's important that before you think about taking up credit and accepting any quote that is put in front of you, have the conversation with the consultant sitting in front of you in terms of what are your options. Do your due diligence. Go online and check out the options that are offered by each institution and whichever institution that you're banking with that you'd want to visit to actually be able to borrow money from. And the importance of this is because, like I said, you don't want to find yourself in a situation where you are utilizing a product for the wrong reasons, because what then ends up happening is that you end up spending more money because you're utilizing the wrong product also. All right, so let's look at this. Sandra's got a personal loan, she's got a credit card, and she's got a clothing account, right? My firstly, I would think about is the two things that I would say to Tando would be firstly, consolidation loan, right? A consolidation loan is a nice way for you to be able to minimize the amount of creditors you have as an individual, right? So if we go back to Tando's example, she has a personal loan, she has a credit card, she has a clothing account. She could possibly go to her institution, whichever financial institution she banks with, and she can ask for a consolidation loan if they offer one. What a consolidation loan does is that the consolidation loan means that they would then borrow her the money to pay off this personal loan, pay off the credit card, and pay off this clothing account, right? They don't give you the money per se. They would pay the money to those particular creditors, right? To avoid a situation where you now utilize the funds for what is not meant to be used. And the reason this is important is because instead of Tando paying in an interest rate, a different interest rate for her personal loan, a different interest rate for a credit card, a different interest rate for a clothing account, if she consolidates her debt, it then means she has one interest rate that she pays and one service fee. Currently, she has three different interest rates. Currently, she has three different interest rates, and she's also paying three service fees for these individual forms of credits, right? And if she's taken the insurance in terms of credit protection, then it means she's paying credit protection for possibly the personal loan and the credit card, which is additional amount of money that is coming out of her pocket, which she could be potentially saving if she were paying for one form of debt in terms of a consolidation loan. So that is the nice thing about a consolidation loan, is because it just consolidates everything for you, and then it allows you to just pay one interest rate and one service fee. And if you're going to be taking the option of credit protection, then it also allows you to take up one credit protection for that particular loan. Then it also gives her a bit of leg room in terms of paying off less installments, because instead of paying three different installments, she'll just be paying for one, right? The other advice I would give her is that instead of thinking around increasing the personal loan or increasing the credit card, why not take a student loan, right? Like I said earlier, utilizing credit for the right reason and utilizing the right product for the right reason is another important thing. Benefits of a student loan, right? a lot of financial institutions offer a student loan, and some of the benefits of that student loan is the fact that the interest rate you pay on the student loan is normally prime, right? So it's not prime plus 5 or prime plus 6, it's just prime, right? Currently, prime is sitting at 11.75%. So it means that particular student loan would be capped at 11.75%. Nice. Secondly, it allows you the option if her daughter is going to be doing a 4-year degree, for example, okay, and then she then says, okay, it's an agreement between her daughter and herself that the daughter would then pay for the loan once she's concluded with the studies. This allows Tando to then rather just pay interest on the loan every single month, right, for the duration of the loan, instead of paying interest and capital, right, which means then capital then refers to paying back the actual loan. So it then alleviates the pressure in terms of her finances, because she won't need to pay for any capital towards this loan. She'll only be paying the interest and the service fee, all right, which is then a cheaper option versus paying off a actual loan when it comes to if she takes maybe a personal loan on an increase on her current personal loan, or utilizes her credit card to be able to pay for the 50,000 Rand registration. So these are examples of why it's important to utilize a product for the right reason. Because, I mean, if she uses a student loan, these are the benefits that she's not going to be able to reap if she uses a personal loan. Because with a personal loan, she does not have the option to just pay interest only for the next 3 years. She would have to pay interest plus the capital, right, until the loan is paid off. But in this instance, with a student loan, she'll be able to pay interest, and then once her daughter finishes her degree, then the daughter can start paying for that particular loan. And the nice thing about the student loan is that every year, if she needs additional money, she can always go back and apply for an increase on the loan. And the increase does not change the terms in terms of paying for interest only. It still kicks in as a new loan. So let's say the daughter needs registration fees for this year. Next year, she will need additional fees, maybe another 50,000 now, paying for the second year of her studies. So Tando can actually go to the bank in the second year and increase the loan from 50,000 to 100,000. But that does not mean that Tando will now need to start paying for interest and interest and capital. She'll still be paying for interest for this particular loan. Every time she increases, she can still take the option of just paying interest only until the conclusion of the loan, or until her daughter pays off, until her daughter concludes her degree, apologies, until her daughter concludes the degree, and then the daughter will then start paying the interest and capital towards the loan. So then that alleviates a bit of pressure on Tando, because she's able to cater for her daughter's fees, and it also is not a financial pressure on her personal finances. All right, so that is just an example, which is a great illustration as to why it's important to ensure that you select the right products whenever you're looking for debt. And this is something that I thought that it was important for us to start with as the first lesson, to try and highlight the different types of lending products and the different types of debt that is available, being unsecured and secured lending, as well as the products that fall in those categories, and why it is important for you to select the right product from the onset. So if we don't have any questions, all right, I'll switch back on my camera and I'll stop sharing my screen. I'll stop sharing my screen and I'll switch my camera back on, just to then say that if we have any questions, and if we don't have any questions, then I'll call this lesson to a close, and we'll catch you the next time when we then continue with our debt management lessons, where we'll then be going further in terms of learning more about debt. Thank you so much for taking the time to join us. Enjoy the rest of the evening. Bye.